Alright, welcome back. Today's video is a good one. It's actually kind of fun, even though Bitcoin is getting crushed right now, at least as we're recording this. By the time you're watching, the price could be higher or lower. It doesn't really matter, because this isn't about today's price. It's about what to do when Bitcoin crashes. And it does crash, over and over again. As of this recording, Bitcoin topped out around October 2025 and has been sliding for roughly 4 months. We're sitting near the $70,000 range. But again, the exact number isn't the point. The real question is this: when price drops hard, especially during those violent multi-day sell-offs, emotions spike. People panic, and we start asking ourselves, should I sell now and buy back lower? Should I buy this dip? What if it keeps dropping? What's the smart move? That's what we're going to unpack. First, we need to understand something important. This is normal. Bitcoin is extremely volatile. It moves aggressively in both directions. If we zoom out to 2018, we see massive drawdowns, from 20,000 down to about 3,500, an 85% crash, then 72%, then 54%, then 77% after the 2021 high into the 2022 bear market. Even during strong bull runs, we see repeated 20 to 35% corrections. In 2024 and 2025 alone, we had multiple 35% drops before new highs were made. And now we're looking at another 50% drawdown. This behavior is not unusual, it's part of the pattern. But here's where hindsight tricks us. Looking backward, it seems obvious. You think, why don't I just sell near the top and buy near the bottom? It looks so clean on a chart. But trading that in real time is a completely different game. There are 3 main approaches people take when Bitcoin crashes. The first is active trading, trying to sell near the top and re-enter near the bottom, timing the market, watching charts constantly. The second is adjusted accumulation. You don't sell, but you change how much you buy. You buy more when it feels cheap. You buy less when it feels expensive. The third is simple, steady accumulation. You buy on a schedule, weekly, bi-weekly, monthly, no matter the price. You don't attempt to optimize entries. Whether you realize it or not, you're doing one of these. The real question isn't which sounds smartest, it's which aligns with your goal. Let's talk about that goal. Some people are trying to maximize dollars. They want more fiat. Hedge funds, traders, people who measure success in cash returns, that's fine. There's nothing wrong with that. Others are trying to maximize Bitcoin. They believe Bitcoin itself is the prize. Their scoreboard is measured in satis, not dollars. The mistake happens when people mix the 2 strategies without realizing it. Personally, I care about increasing my Bitcoin position, not my dollar balance. And that distinction changes everything. Let's examine strategy number 1, trading. On paper, it looks simple. Bitcoin moves a lot. Just sell high, buy low, repeat. But to succeed, 4 things must happen consistently. First, you have to correctly identify tops, not after the fact, but in real time. Second, you must avoid panic at bottoms. You can't sell out in fear or hesitate during extreme volatility. Third, you must re-enter before the rebound. This is critical. Bitcoin's strongest up days often happen right after its worst down days. Fourth, you must repeat this successfully over and over. That's where it breaks down. Data shows that a huge portion of Bitcoin's yearly returns come from just a handful of days. In some years, the best 10 days produced over 150 or even 200% returns. The rest of the year was flat or negative. If you miss those few explosive days because you're sitting in cash waiting for confirmation, your performance collapses. Over the past decade, missing just the 5 best days significantly reduced returns. Miss 10 or 20 of them and the damage becomes severe. Not just in dollar returns, but in total Bitcoin accumulated. And that's before considering trading friction. Every trade has fees. There's slippage. Bid-ask spreads widen during volatility. Orders don't always fill perfectly. And taxes create a permanent capital drain. Selling triggers a taxable event. That means less capital to redeploy. Even if you time things well, those small costs compound against you. Trading can work for disciplined, skilled operators who understand the risks and accept the pressure. But statistically, it's extremely difficult. Now let's look at the second approach, adjusting your accumulation. This feels smarter. Buy heavier when price is low. Buy lighter when price is high. For example, when Bitcoin approaches its 200-week moving average historically, that has been a strong buying zone. Every time price touched that level in past cycles, it offered major upside. So you might think, I'll deploy more capital there. The problem is defining expensive. Bitcoin can stay overextended for long periods. You might stop buying because it feels pricey, only to watch it double again. Or you buy aggressively at what you think is cheap, and it drops further, leaving you without dry powder. Indicators like MVRV can help identify extremes, but they're imperfect. Signals change over time, markets evolve. What worked in 2017 may not work the same way today. Trying to fine-tune entries reduces your participation. And in a long-term uptrend, participation matters more than precision. That brings us to the third approach, continuous accumulation. This one is simple. You buy consistently, regardless of price. You stay exposed. You don't attempt to predict short-term moves. It's not exciting. It doesn't feel clever, which is often why it works. With this method, you are always in the market during those massive rebound days. You eliminate timing stress. You eliminate trading drag. You eliminate taxable churn. Volatility stops being something you fear. It becomes background noise. Look at companies like Tesla. Massive drawdowns, 40%, 70%, 50%. Yet Elon Musk didn't become wealthy by trading Tesla shares. He became wealthy by owning them. Same story with Amazon. Brutal crashes, deep bear markets. Jeff Bezos didn't trade in and out, he held ownership. Warren Buffett famously said that if you're not willing to own something for 10 years, don't even think about owning it for 10 minutes. Ownership creates wealth. Trading attempts to extract it. Now here's the deeper question. Why aim to accumulate Bitcoin instead of dollars? Because I don't view Bitcoin as a trade. I view it as a monetary asset. We are living through technological and monetary shifts. The global financial system is evolving. Trust between nations is fragmenting. Trade still needs to function, but neutral settlement mechanisms are limited. Gold has historical value, but it cannot move instantly across the world. It cannot settle in minutes without intermediaries. Bitcoin can. If Bitcoin becomes a neutral reserve asset over decades, it will absorb significant value. In that world, the risk isn't holding too much Bitcoin, the risk is holding too little. So when price crashes, I don't ask, how can I flip this for more dollars? I ask, how can I increase my ownership? That's the difference in scoreboard thinking. You have to decide what you're optimizing for, cash returns or Bitcoin position. Once you define that clearly, your strategy becomes obvious. Let me know where you stand, and as always, to your success.